The 10-year Treasury seems to want to hang out over 4% these days. So the longer that it hangs out over 4, it's at 4.01% today. So let's hope that we dip down into the high 3s. But the longer it hangs out over 4, that means that the next resistance line is going to be about 4.25. So prior to this, that resistance line was 3.92%. It broke that, and it's kind of been staying above that for the last few weeks. It just seems like the market wants higher rates right now. So we're going to watch that closely. But we've got some other reports that came out over the last week that are sort of helpful to the cause of hopefully stopping with the rate hikes or pausing. For one, manufacturing indices are down across the board. So manufacturing as a whole is down, and that's reflected in the numbers finally. JOLTS job openings were close to expected at 187,000 jobs. That is the lowest since December 2020. Non-farm payroll is slightly lower than expected, so that's good. Good meaning for rate hikes. Global shipping, they revised their original forecast. So originally they thought global shipping would be down about 2.5%. They adjusted their forecast to 4%. So they're forecasting that global shipping will be down 4% across the board. So we're definitely starting to see all of the signs of a recession. To be fair, I think real estate has been in a recession, but jobs has been the big thing that we've been waiting on to officially announce the recession. So that being said, we also have that SLOOS report that came out. I know I talked about this last week, but let me tell you this. This is one of, right now, the times that we are living in is considered to be one of 4 of the tightest credit environments in history. Okay, guys? So the 3 other times were basically the Great Financial Crisis of 2008, COVID, and the dot-com crash. And today we have our 4th highest, the tightest credit standards in history. Don't you feel so special to be part of history right now? Anyways, let's see what else is happening. When I talk about the Treasury being north of 4, everybody kind of wonders why, because we had some news that should have brought the Treasuries down, right? But instead, Treasuries went up after the Fed hiked rates. It usually kind of tumbles back down. Now, the reason is not necessarily, like I said, because of the Fitch downgrade. That's kind of like, ugly step cousin nobody seems to care about. They don't really put a lot of weight in that. But what is important about the Fitch downgrade is really what led to that, which is obviously irresponsible spending, limitless borrowing, all those debt ceiling standoff that we had. That kind of stuff is what's contributing, I think, to the higher Treasuries. It could be a phenomenon because Bloomberg is still expecting that the 10-year Treasury is going to be at 3.32 by the end of the year. So we're up just over 4% today. So this could be a really short-term thing. We just don't know yet. Obviously, we're living in some very dicey times, but it does seem like the market wants higher rates. So again, with that jobs report, that's the lowest since 2020. The one thing I want to say is every single month this year, the one thing nobody seems to be talking about is that basically they keep, after every jobs report, they keep readjusting the forecast down. So their forecasts were originally higher, but they readjust them before the next one's announced. So then it looks like we're closer. So it's a little bit of an illusion. So jobs are actually down quite a bit more than forecasted. They just keep changing the forecast right before the numbers come out. So it's not showing that as much. Average hourly earnings came in at 4.4%. It's the same as last month. We had expected it to drop to 4.2%. So that's a little disappointing, but there is some kind of numbers being fudged because it actually has dropped lower than we think. One of the things I want to say here is that full-time jobs dropped by 585,000. That is the biggest drop since COVID. Part-time jobs surged 972,000. So basically what that means is that people aren't really getting the jobs that they want. So they're getting part-time jobs. More people are working part-time. Why? Because they don't have the job they want. They're not getting the pay they want or need. So they have to pick up a part-time job. So this number is a little bit deceitful because of the uptick. It doesn't show that in the average hourly earnings numbers. So that's something to kind of look at, that more and more people are working more part-time jobs than are holding full-time jobs. And that's happening at a pretty decent rate. So let's see, JOLTS. The JOLTS report, that is the job openings. There were 11.2 million jobs at the end of last year. That number is now 9.5 1.5 million. So it is falling, and this is sort of what we need. This is what we're looking at. But one of the most important things I want to say is that about the jobs report is that there's not going to be much pressure on the Fed to cut rates if we aren't losing jobs. So this probably means that we're going to have higher rates for longer. And even though they might be done hiking, I don't think they're going to be cutting anytime soon. So this is interesting news for us because obviously a lot of our loans, like, for example, people are more interested in getting lines of credit now because they have really low interest rates on their first trustee, their primary. They got at 3%, whether it's even an investment property, you're probably somewhere around 3 to 4.5%, let's say. And a lot of us are in the threes, especially in commercial. We refinance, we got really good rates. So some of us are looking at maybe getting lines of credit, even on your home, residential properties, you're looking at getting lines of credit. Well, those are tied to prime. So prime is currently at 8.5%, and we are forecasting that the Fed's not going to cut rates for a little while. It's going to be longer than we originally forecasted. So that's kind of where we're at today. Of course, these things could change at any point in time, but this is sort of what we're seeing right now. That being said, this week we are going to have a CPI, another inflation reading, but don't freak out because I think it's going to come in higher. Basically, the Fed's measure of inflation, they do it year over year. So inflation peaked 13 months ago. So that means that we're starting to fall into months where we're seeing a rapidly falling inflation number from a year ago. So some of those higher numbers have dropped off, which means when you're looking at the average, it could look like inflation's gone up or that it's flat. Don't freak out about that. Hopefully the media won't, but they love to make a frenzy about these things. What we want to pay attention to is the monthly inflation data, which we're expected to see it at 0.2%, just like it was last month. However, that inflation, the year over year inflation measure is looking like it's going to be higher just because, like I said, that super high inflation number we got of 9.1% 13 months ago fell off. So now we have much lower numbers. And so the average is not going to show as much of a drop as it did over the last couple of months. Don't worry, it will start to normalize over the months. As long as we keep that same kind of or around that 0.2% monthly number, we're good to go. So that is the big news for this week. We're going to see by the end of the week, CPI and PPI inflation data. That's coming out Thursday and Friday. So let's watch for that. In terms of rates, rates are up, guys. If we're watching Treasuries, it's my job to watch Treasuries. So they're up. A lot of lenders that were kind of holding their rates for the last few weeks, even though Treasuries had already gone up, are now officially raising because it looks like rates are kind of just hanging out here. So a lot of our lenders don't necessarily have a spread over Treasuries. A lot of our lenders have fixed rates. Some do go according to Treasuries, but they're also raising their spreads. So where we used to have a spread of maybe 225 to 250 over the Treasury is now 275 to 300 over Treasury. So they are increasing their spreads. There is this kind of looming. I just saw an article on Globe Street last week that they were anticipating there to be some pain in the multifamily sector as well, because think about it, a lot of us are hanging out in 3% rates. If your rate's set to adjust, one thing that most people don't know about their apartment loans or their commercial loans is that usually the first rate adjustment, there is no cap, guys. So it would be the margin plus the index. And then after that, you're usually capped at 0.5% to a 1% cap on the next adjustment, meaning that it could go up 0.5% to 1% at the most or down, either way, with your floor being the rate, your start rate. So check all of that. If your rate is set to adjust, usually that first adjustment has no cap, okay? I just talked to a client about this yesterday, actually, that their rate is set to adjust. They were at 5.5. It was actually a higher rate at the time. It was a little bit of a tougher property, but now if their rate were to adjust, they're going up to 9.5 because that first adjustment is not capped. So please take a look at that. Have me take a look at it. If you have any questions, give me a call. If your loans are set to adjust, take a look at your loan agreement or the note, depending on which lender it was. It should have that verbiage in there about the rate caps after the fixed period, what it's going to adjust to. God forbid it's not a balloon, hopefully, but take a look at that because that is something for you guys to really, really understand before your loan adjusts, and knowing whether or not it's smart for you to just refinance or just let the rate float while we wait for better times, a better interest rate environment. So with that said, have a fabulous week. You probably won't hear from me next week. I'm going on vacation for 7 days. So have a fabulous next week, everyone, and rest of the week. And thank you so much for all your support. I really appreciate it. And I'll see you when I get back.